Get ready for the news that is shaking up the markets. We start with the incredible performance of Nvidia stock. We are diving deep into the 1,403% share price gain Nvidia has seen in just 5 years, and exploring the crucial lessons investors can take away from this massive surge. Discover what this astronomical growth tells us about market dynamics and long-term investing strategies. Software. We'll tell you exactly where the real investment potential lies among these three. Finally, we turn our attention to a massive surprise performer that is redefining the AI economy. Lead tech analyst Bate Kindig has named Bloom Energy as her top 2026 stock pick, pointing to physical constraints as the real bottleneck. We investigate how Bloom Energy is surging 217% year-to-date, and why this energy stock is positioned perfectly for the AI era. Stay with us for the full breakdown. Nvidia's staggering 1,403% stock price surge over 5 years has sparked debate amidst the current AI investment frenzy, prompting investors to consider lessons beyond the immediate AI hype. While some are wary of the AI mania, the performance of Nvidia, Nasdaq, NVDA is being analyzed for broader investment principles. An investor perspective suggests that Nvidia's historical trajectory, dating back to its 1999 listing, offers valuable insights into market dynamics. The analysis points to the concept of competing in markets with relatively small numerical demand but high pricing power. This is illustrated by UK companies like Rolls-Royce, LSE, RR, which thrive by commanding premium prices for complex products, such as aircraft engines, creating significant barriers to entry and a strong installed base for servicing contracts. Rolls-Royce has also seen substantial gains, with its share price rising 973% over the last 5 years. However, the comparison with Nvidia highlights the difference in scale. While Rolls-Royce benefits from market niche dominance, Nvidia's immense valuation is driven by its ability to command extraordinary pricing power, largely due to proprietary chip designs, which translate into significantly higher operating margins. Nvidia's last year's margin reached 60%, compared to Rolls-Royce's 25%. Despite the strong performance, the author expresses caution regarding Nvidia's valuation, noting that its stock trades at 46 times earnings, which is deemed too high for long-term investment tastes. Concerns remain about the long-term demand for costly AI chips and the potential for rivals to erode Nvidia's pricing advantage with lower-priced alternatives. Ultimately, the author is not currently investing in Nvidia, but is applying the lessons learned from its performance, specifically concerning pricing power and market dynamics, to their search for non-AI stocks. Stock futures experienced a decline following a record-setting week in market activity. Traders are currently focused on upcoming earnings reports from key technology companies, specifically Nvidia and the retail sector, as the market awaits these crucial data points to determine future direction. Nvidia, CoreWeave, and Palantir are positioned at the forefront of the artificial intelligence revolution, each driving growth in distinct segments of the AI ecosystem. The AI boom, ignited by Nvidia's breakthrough in graphics processing units in May 2023, has spurred massive investment across hardware, specialized cloud infrastructure, and enterprise software. Nvidia stands as the undisputed leader in AI chip design, dominating the hardware accelerator and semiconductor market with an estimated 90% market share for AI GPUs. Its competitive edge is cemented by its proprietary CUDA software platform, InfiniBand networking, and rapid product introduction cycles. Driven by soaring demand from AI data centers training models like ChatGPT, Gemini, and Claude, Nvidia's outlook remains highly optimistic, with Wall Street projecting Q1 FY 2027 revenues to reach $78.8 billion, despite facing headwinds from fabrication capacity constraints and geopolitical export restrictions. CoreWeave, which went public in March 2025, capitalized on this demand by monetizing its existing Nvidia GPU cache for specialized AI cloud services. Operating as a neocloud provider, CoreWeave competes directly against hyperscalers like Oz by offering faster, more specialized GPU as a service. Its success is bolstered by priority allocations of Nvidia's B200 and H200 chips and advantages in liquid cooling and rapid deployment. While CoreWeave's stock has seen significant appreciation, its primary challenges include heavy capital expenditure requirements and the risk of drying up funding for AI startups. Palantir occupies a different space, focusing on enterprise AI software, data integration, and defense analytics. Unlike Nvidia and CoreWeave, Palantir utilizes AI chatbots to augment existing data analysis capabilities rather than inventing core hardware or infrastructure. Its strength lies in its near monopoly in U.S. defense data integration, leveraging a proprietary ontology to map complex, disparate data sources. However, Palantir faces investor skepticism, with analysts frequently issuing cautious ratings due to high valuation multiples and vulnerability to any deceleration in U.S. commercial growth. Investor perspectives vary significantly across these leaders. Nvidia is viewed as the most financially solid, demonstrating sustained rapid growth, high margins, and innovation pace, making it the most compelling outlook for the broader AI sector. CoreWeave is seen as a crucial early indicator of the specialized cloud sector's viability. Palantir carries the highest risk due to valuation pressures. In summary, while all three companies are experiencing rapid growth, their risk profiles diverge. Nvidia leads in market dominance and financial stability, CoreWeave in specialized infrastructure adoption, and Palantir in high-value enterprise software integration. Analysts are overwhelmingly bullish on Nvidia, whereas CoreWeave receives a moderate buy rating, and Palantir is often rated as a hold. Investors must weigh these distinct competitive advantages against risks, such as customer concentration for Nvidia, capital intensity for CoreWeave, and valuation compression for Palantir. Tech analyst Bate Kindig has named Bloom Energy as her top stock pick for 2026, citing the firm's critical role in solving the physical power constraints facing the burgeoning AI economy. Bloom Energy has demonstrated exceptional financial performance, with first quarter 2026 revenue hitting $751.1 million, marking a 130.4% year-over-year surge, and adjusted earnings per share exceeding Wall Street estimates by over 242%. Kindig argues that the primary risk to AI scaling is not compute supply, but rather the immediate availability of power. Bloom Energy's behind-the-meter solid oxide fuel cells address this bottleneck by helping data centers bypass lengthy utility interconnection queues, positioning the company perfectly for the power demands of AI inference in dense urban areas. Institutional sentiment is strongly supportive. RBC Capital reiterated an outperform rating and raised its price target to $335, highlighting grid constraints as a key catalyst. UBS maintained a buy rating and raised its target to $251, noting that Bloom's technology aligns with the shift toward more efficient 800V DC architectures in data centers. In market performance, Bloom Energy has significantly outperformed the broader market. Its shares have surged 217.59% year-to-date, vastly eclipsing the Nasdaq Composite's 12.87% advance. Over the past 6 months, the stock has seen a staggering 1,292.28% rise. While Nvidia shares rose 13.3% year-to-date, Bloom Energy's momentum has been far more pronounced. Recent activity shows strong demand, evidenced by Oracle Corp's pivot to a 100% Bloom energy solution for its Project Jupiter AI data center campus, aiming for faster deployment. Bloom Energy shares are currently edging higher following post-earnings resets and analyst upgrades, underscoring its status as a key infrastructure play in the AI revolution.